Everyone talks about returns, few talk about risk. But in zero DT trading, ignoring risk adjusted returns is how you go from consistent gains to blowing up your account. Today, I'll show you how I evaluate risk adjusted returns, why it's the key to long-term success in trading, and how to structure your portfolio for stable, scalable growth. For those of you that are new here, my name is Mark Anderson and I run a zero DT hedge fund that has traded zero DT for over 1,000 days in a row, and I've sold over $50 million in zero DT premium. I don't do this because I'm trying to sell you a course. I do this so I can give real advice. I make these videos simply because I've had a fair share of difficulties learning zero DT trading, and I want to create no BS content based on real world experience so you can find your path to wealth like I did. Why CAGR alone is misleading. Let's talk about one of the biggest mistakes traders make, chasing high CAGRs or compounded annual growth rates. Sounds great until you realize it doesn't account for the volatility, drawdowns, or risk you're taking. A strategy showing an 80% CAGR might look amazing, but if it comes with a 30% drawdown, it's not as impressive as it seems. The other thing is we are using back-tested data, and I can almost guarantee you whatever your projected drawdown is, your portfolio will hit that within the next 90 days. Think of it this way. Imagine you're driving a car. CAGR is like the average speed you drive over a long road trip. If you tell someone we averaged 80 miles an hour, that sounds great, right? But if you didn't tell them that they don't know that at sometimes you were swerving through traffic at 120 miles an hour and at other times you were slamming on your brakes in traffic, that's kind of erratic driving and it's risky. One mistake could end that entire car ride. A trader chasing a high CAGR without considering drawdowns is like a driver obsessed with speed, but ignoring whether they're staying in control of their car while they're driving. The real measure of how smooth and controlled a trip isn't how fast you got there, but how safe and stable you were when you were driving your car. Think of it this way. There's a big difference between you trying to get somewhere as fast as possible and then you driving your kids to get somewhere as fast as possible. CAGR versus risk-adjusted CAGR comparison. Let's look at two examples. Strategy A, a 50% CAGR with a 10% drawdown. Strategy B, 100% CAGR with a 20% drawdown. Which one of these is really better? Instead of focusing on the CAGR alone, you need to check how bumpy the ride is along the way. That's where risk-adjusted returns come in. A way I like to think of it is, your P&L is the road to your financial freedom. But when you have a poor risk-adjusted returns, that P&L curve is littered with potholes. Optimizing for risk-adjusted returns fills in those potholes or drawdowns along that P&L curve to financial freedom. What you should focus on is risk-adjusted returns. How much return are you getting per unit of risk you are taking? And that's where the sharpe ratio, the sortino ratio, and the max drawdown compared to the annualized risk return ratio, otherwise known as MAR. These all come into play, and we'll cover this next. The metrics that matter. Number one is our sharpe ratio. This is the total risk we take minus our adjusted performance. Sharpe measures how much return you get per unit of volatility or drawdown you take on. Imagine two ways to reach the top of the building. One is a roller coaster, big highs, sudden drops, and unpredictable movements. The other is smooth and steady, like an escalator, a near 45-degree line. If you measure only how high each one goes by the CAGR, then it might seem like it's something different. But if you measure the risk you're taking along the way or the volatility, the roller coaster is obviously way more dangerous than that 45-degree escalator. The sharpe ratio is the return of your investment minus the return of the risk-free rate of the investment or the 12-week treasury bill divided by the volatility of that investment. A strategy with a sharpe ratio of 2 means you're getting twice the return for every unit of risk or volatility. In zero DT trading, anything above 2 for sharpe ratio is solid and above 3 is elite. A high sharpe ratio means your trading returns are like an escalator, steadily climbing without scary drops. A low sharpe ratio means you're riding the roller coaster, big gains, but just as many big losses. The next one I would like to cover is the sortino ratio, penalizing you only for the downside risk. Sortino is like Sharpe's smarter cousin. Sortino is better because it only considers the downside risk or volatility, not the upside. And in trading, that's what we actually care about. There's no reason to penalize a strategy for big upside volatility gains. We want those big wins. The Sortino ratio is the return of the investment minus the return of the risk-free rate or the 12-week treasury divided by the downside volatility of that investment. Here's a way to think about it. Let's say you have two basketball players. We are looking to build a team around them. You've got two legendary players. We'll look at Shaq and Steph Curry. Shaq is a center that almost exclusively dunks the ball, and Steph Curry mostly shoots three-point shots. Shaq is an example of a high sharpe ratio player. He makes 60% of his shots, but they are nearly all dunks, being worth only 2 points. He's like a high sharpe ratio strategy, smooth, steady, and low volatility overall. Every time he touches the ball, he averages 1.2 points per shot attempt. Steph Curry, on the other hand, shoots threes. Steph is a high Sortino player strategy because he may only make 50% of his shots, but half of those shots are worth 3 points instead of 2. So he averages 1.5 points per shot attempt. Sortino ratio rewards that kind of efficient, asymmetric scoring because it focuses on how you perform during the bad times, not just the overall consistency. Sortino only measures your misses and doesn't penalize you for three-point shots. It's all about how bad your losses are, not how many crazy upside three-point shots you make. That's why it's often a better fit for trading strategies aiming for convex payoffs and controlled drawdowns. The sharpe ratio is like measuring only the missed shots. It penalizes a strategy that's taking good risks, like open three-point shots instead of just two-point dunks. If your Sortino ratio is higher than your sharpe ratio, it means that you're taking smart risk, more upside with controlled downside. Think of Steph Curry draining threes, not just playing it safe in the paint like Shaq. But if your sharpe ratio is higher than your Sortino ratio, that's obviously a red flag. It could mean that your portfolio is too volatile on the downside. You're taking big risk that your sharpe ratio doesn't distinguish from your upside spikes. Here's the bottom line. High Sortino ratio strategies, you're winning the right way. More rewards with less drawdown and volatility. Low Sortino ratio strategies, your losses hurt more than your gains help over time. And then our next ratio, maximum drawdown to annualized return ratio, otherwise known as the MAR or MAR ratio. This is basically your CAGR divided by your max drawdown over that period. The MAR ratio is your tightrope walker. One is walking 10 feet off the ground. If they fall, it's a small stumble and they can get back up easily. The other is walking 100 feet up with no safety net. A fall could be catastrophic or deadly to your portfolio. Both tightrope walkers may take the same number of steps, that's the CAGR, but the one walking up really high with potentials of high drawdowns is taking way more risk than the other. A high MAR ratio means even if you trip, you're not falling as far. You can recover from that quickly. A low MAR ratio means one bad move could be your last. The best traders walk the tightrope at a manageable height that they can replicate and stay at for a long period of time. If your CAGR is 40%, but your max drawdown is 50%, you have a MAR ratio below 1. That's dangerous. A MAR ratio of 5 and above means you're compounding well while managing your risk. Also, sizing is very important here. When you look at the MAR, any MAR that has a drawdown over 10% is jeopardizing your ability to achieve those results over any long period of time, because any mistake above 10% can incur a volatility drag. Let's say you took a 25% drawdown, you now need a 33% gain to get back to even. Here's a quick recap. Sharpe ratio is your return of an investment minus the return of the risk-free rate divided by the total volatility of that investment. It's your total risk-adjusted return. 2 is solid Sharpe ratio. 3 and above is an elite Sharpe ratio. Then there's your Sortino ratio, which is the return of the investment minus the return of the risk-free rate divided by the downside volatility of that investment. When we look at this, we want a minimum of 3 for our Sortino ratio, and above 5 is extremely good. The last ratio is our maximum drawdown to annualized risk return, or our MAR ratio. This is our compounded annual growth rate divided by our max drawdown over that period of time. You can think of it as your stability versus your drawdowns. Above 4 is a good MAR ratio, above 6 is ideal. How do you implement these ratios in your trading process? First, track your returns and your volatility. Use a spreadsheet or trading platform to log your daily divided by your weekly portfolio returns. Calculate your total standard deviation for Sharpe ratio and your downside standard deviation for Sortino ratio. 2, compare strategies before committing to them at full size. Before scaling up your strategy, check its historical Sharpe ratio, Sortino ratio, and MAR ratio. Run these through a Monte Carlo analysis to get an objective view at the worst case scenarios. Avoid strategies with lower Sortinos below 2 and low MARs below 3. They're just too risky and not worth it. 3, monitor your performance in live trading. Backtests don't account for slippage and execution that well. We're essentially guessing on those. The process of developing accurate systematic portfolios over time is by using your actual forward tested results that were achieved in real trading for slippage and execution while comparing them over the period to the backtest and the forward test for 6, 9, even 12 months. Continue to update your ratios every quarter to see if they hold up in live trading, what your assumptions are for the MAR, Sortino, and Sharpe. Here's how I break down my portfolio. It's like a 3-legged stool, balanced and resistant to falling over and failure. 50% of my portfolio are high frequency trades that yield small gains, low drawdowns, high MAR ratio, lower win rate. 25% of my trades are medium frequency trend-based trades, solid risk-adjusted returns, lower Sharpe ratios, and a medium MAR but a high Sortino ratio. And 25% of my trades are high reward, low frequency, convex trades, lower MAR, hedging against tail risk, but can provide massive upside gains and keep the Sortino high. The key here is diversification, not just in strategies, but in the type of risk you're taking. You need trades that work in low volatility environments, trades that work in high volatility environments, and extreme shock scenarios as well. This is how you stabilize your returns over time to make a living from trading. Backtest versus real performance, what I watch for. Addressing why we think great backtests can be misleading. Even if a strategy shows a great Sharpe or Sortino or MAR or all 3 in a backtest, I always ask, how stable is this across different market regimes? Backtesting is practice. It looks good under perfect conditions. Live trading is game day. If your strategy isn't built for the real world conditions, slippage, executional risk, and unexpected volatility, it won't perform the same way as the backtest. The real test is how it performs live over 6, 9, or 12 months of forward testing. If a strategy can't maintain its risk-adjusted performance over time, it's not reliable and you're flying blind. Here are some common backtesting pitfalls I see. 1, excluding past data and only entering when overfit filters and parameters are present. I call this taking on a considerable amount of data risk. 2, failing to account for accurate slippage and executional risk while not tracking your forward tested results over time to see if those match. I call this creating edge through execution and not using a margin of safety. 3, falling into the trap of recency bias by only using strategies that have recently been in favor. For all of my testing, I always exclude the last 6 months of trading to have an out of sample period to prevent myself from doing this. Bottom line, if anyone can make big returns, the real winners in 0DT are the ones who can control their risk and compound effectively over time. If you focus on risk-adjusted returns and not just the CAGR, you'll trade smarter, last longer, and scale faster. Thank you everyone for watching. Like and subscribe for more high-level 0DT strategy breakdowns. Comment below what your biggest challenge is with risk management in 0DT, especially what's happened in this recent market environment. I'll see you guys in the next one.